We're jumping straight into Netflix today. Everyone is watching the price action, but the real story is the massive disconnect between the stock price and the business fundamentals.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get rolling, if you want to stay ahead of the curve and get these kinds of market insights delivered straight to you, make sure you subscribe and hit the like button. It really does help us out.
It does. And we have a really fascinating setup to talk about today.
Yeah, we really do. So let's just set the stage for everyone. It's late February 2026.
Right.
And if you're glancing at your portfolio or, watching the ticker tape, you're seeing Netflix trading right around $77.
Which is a pretty painful number to look at right now.
It's rough. I mean, we are talking about a stock that is down 19% year to date.
Yeah.
And if you zoom out a bit further over the last 6 months, it has shed more than a third of its value.
Over 33% just gone.
Right. So it definitely feels like the broader market has just completely turned its back on the company.
The sentiment is undeniably toxic right now.
Mm-hmm.
But here is the conflict, and this is exactly why we're breaking this down today.
I hear it.
You have the stock price dropping like a rock.
Yeah.
Right? Acting like the company is in some kind of systemic danger. But when you actually pop the hood...
And look at the engine.
Exactly.
Yeah.
When you look at the business itself, it's actually growing faster than it has in years.
It's a complete tale of two realities. The chart looks terrible, but the financial statements are looking incredible.
It creates this massive cognitive dissonance for investors. Normally, price follows performance.
Sure.
But here, the price is heading south while the actual business performance is heading north.
So let's break down that bullish argument first. The why behind the buy, so to speak, because despite the sea of red on the screen, we are seeing some major moves from the smart money.
We are. And we really need to talk about Coatue Capital.
Yes. This is my favorite part of the story. It's like watching a high-stakes poker game, and you see the quiet pro at the table just push all their chips into the center while everyone else is panicking and solding.
Coatue is not a retail day trader. They are a massive institution.
Right.
They manage tens of billions of dollars, and they specialize in technology and media. They understand the platform economy.
So they aren't just taking a blind guess.
Not at all. They do deep, deep homework. So when they make a move, you pay attention. And in the fourth quarter of 2025, they didn't just add a little bit to their Netflix position.
They didn't just nibble.
They feasted. They aggressively expanded their stake from roughly 600,000 shares to about 6 million shares.
Okay, let's just pause on that math for a second.
Am I staggering?
It is. That is a 10-fold increase. 10 times their previous position.
In a single quarter.
You don't increase a position by 10 times, especially when you're dealing with millions of shares, unless you have extremely high conviction that the asset is mispriced.
No, you don't.
Yeah.
That isn't just, averaging down to save face on a bad trade. Buying 10 times your original stake is a massive signal.
It's them looking at that $77 price tag and saying, the market has this entirely wrong. We are backing up the truck.
Exactly. So the obvious question is, what are they seeing that all the panicked sellers are missing?
Right, because usually when a stock drops a third in 6 months, there's a fire somewhere. Is the business broken?
It really isn't. And it comes down to what we're calling this dual-engine growth model.
I love that phrasing, dual engine. Because for the longest time, this company was strictly a single-engine plane.
Yes, it was all about subscriber growth.
That was the only metric anyone cared about. How many new people signed up this quarter? If that number went up, the stock went up. If it went down, total panic.
But that single engine is actually still firing beautifully. Let's look at engine number one, the top line. The revenue acceleration is undeniable right now.
Give us the numbers.
In the fourth quarter of 2025, revenue hit $12.1 billion. That is 17.6% growth year over year.
And we have to put that in context. That 17.6% isn't just a static number, it's an acceleration.
Right.
It's up from 17.2% in Q3 and 15.9% in Q2. So the growth rate is literally speeding up.
Which is incredibly impressive when you look at the sheer scale they operate at. We aren't talking about some nimble startup looking for its first million users.
No, they have 325 million paid memberships.
That's the law of large numbers. Normally that works against you. It's relatively easy to grow 50% when you only have 10 customers.
But trying to grow almost 18% when you have a third of a billion customers.
It's like trying to turn an aircraft carrier like it's a jet ski. It defies corporate physics.
But they're pulling it off.
Yeah.
Which brings us to engine number 2. And I think this is the real game changer. This is the moat that Koa2 is betting on.
The advertising business.
Yes. This changes the math entirely.
For years, the big bear argument was that Netflix had a hard ceiling. Eventually, you run out of humans on Earth to subscribe, or you raise prices so high that they all cancel.
But then they rolled out the ad tier.
And remember the absolute skepticism
Well,
around that.
I was one of the skeptics. People were saying it would ruin the brand, that users would revolt.
Premium content shouldn't have ads, right? That was the narrative.
But the data completely dismantled that narrative. It's working incredibly well.
In 2025, that advertising business generated over $1.5 billion in revenue.
$1.5 billion, that's not an experiment anymore. That is a massive real business.
And it was growth of over 150%. Plus, management expects that ad revenue to roughly double again in 2026.
Which is so crucial because it decouples their revenue growth from the consumer's wallet.
Exactly.
Before, if they wanted to make more money, they had to ask you and me to pay more per month. Every price hike creates friction. You look at your credit card bill and think, do I really need this?
Now they can monetize your attention instead. They can grow revenue without aggressively hiking subscription prices.
Which is a massive strategic advantage in a crowded market.
Yeah.
And the really counterintuitive part of this.
The ARM?
Yes, the average revenue per member. The ad tier subscribers are actually more valuable to the company than the premium ad-free subscribers.
It's brilliant. Even though you pay less out of pocket, say $7 a month instead of $15, the ad revenue they collect on the back end more than covers the difference.
So they actually want you on the cheaper plan. You feel like you're getting a great deal, and advertisers are paying the difference to reach you.
It's a win-win that dramatically reduces churn. And it feeds directly into the profitability story. We really need to talk about margins.
Because revenue is vanity, profit is sanity.
Exactly. And the margins here are expanding beautifully. It all comes down to operating leverage.
Let's quickly clarify that for the listener. What does operating leverage actually mean in the streaming business?
Think of it like this. They have massive fixed costs. They spend billions to make a blockbuster show. But once that show is in the can, the cost is locked.
Right. It costs them the exact same amount whether 1 million people stream it or 100 million people stream it.
Right. So every new dollar of revenue that comes in, whether from a new subscriber in Brazil or a new ad spot, doesn't have a new production cost attached to it.
It just flows straight to the bottom line.
That's operating leverage. As you scale, you become exponentially more profitable. And we're seeing that flow through the numbers.
Operating margins expanded to 29.5% in 2025.
And for 2026, they are guiding to hit 31.5%.
So for every dollar they bring in, they're keeping almost a third of it as pure operating profit.
Which turns into a mountain of cash. They have what we call a fortress balance sheet. They ended 2025 with $9.1 billion in cash.
$9 billion. Just sitting there.
But they aren't just sitting on it. This is the kicker. In 2025, they bought back over $9 billion of their own stock.
Okay, let's unpack stock buybacks. Because some people hear that term and their eyes just glaze over.
Sure.
Why does it matter to you, the listener, if Netflix buys its own shares?
Well, think of the company as a pizza. When you buy a share, you own one slice of that pizza.
Oh, okay.
When the company buys back its own shares and retires them, they're basically taking slices off the table and making them disappear.
But the amount of actual pizza, the total profit, stays exactly the same.
Right. So the remaining slices, the ones you hold in your portfolio, suddenly represent a bigger percentage of the total pie.
So even if the company's total net income didn't grow at all, your share of those earnings, your earnings per share goes up simply because there are fewer shares in existence.
Exactly. It boosts the value of your shares without you having to do anything. But more importantly, it's a massive signal from management.
Right. They aren't doing it just to be nice.
They do it when they look at their stock price and think, this is way too cheap. The best investment we can make right now is buying ourselves.
And speaking of investments they chose not to make, we have to talk about the strategic discipline they showed recently.
The Warner Bros. Discovery rumors.
Oh, man, the market was buzzing about that. Everyone thought Netflix was going to swoop in and buy Warner Bros. To get their hands on that massive HBO library.
It felt like an inevitable media mega merger.
But the market hates those deals, right?
Yeah.
They are incredibly messy.
They're terrible for short-term shareholder value. You take on massive debt, you dilute your stock, and in that specific case, you'd be taking on all these legacy cable networks that are slowly dying.
It's like buying a factory that makes fax machines.
Precisely. But Netflix stayed disciplined. They avoided the bid entirely.
Which was a massive relief to the market. It showed they aren't trying to empire build for the sake of ego.
They're keeping their powder dry to invest in organic growth, their own ad tech, their own content.
Okay, so if we zoom out on the bull case here, you have accelerating revenue, an advertising business that is exploding, expanding margins, a mountain of cash, massive stock buybacks, and management that isn't chasing stupid mergers.
That sounds perfect.
It really does. But, and there's always a but on this show.
Always.
The stock is still at $77. It's still down 19% this year. So someone out there is aggressively selling. We have to look at the flip side.
We do. We need to look at the bear case. What are the risks that could actually send the stock even lower?
Let's start with the valuation danger zone, because even at $77, some analysts believe there is still a long way to fall.
Right. Valuation is relative. Right now, it's trading at roughly 24 times forward earnings.
Which, for a tech company growing at almost 18%, doesn't sound completely outrageous.
It's reasonable if you view them as a pure tech growth story. But the bear argument asks a very different question. What if the market stops viewing them as a tech company?
And starts viewing them as a traditional media utility, like a Disney or Comcast.
Exactly. Traditional media companies trade at much lower multiples because they have lower growth and heavier baggage.
So what happens to the math if that shift occurs?
If that multiple compresses down to, say, 18 to 20 times earnings, models suggest the stock could fall into the $56 to $62 range.
Ouch. So dropping from 77 down to the high 50s, we are talking about another 18 to 26% downside.
Yes. And the scary part is that drop doesn't require the business to actually fail. It just requires the market psychology to shift.
And what usually triggers that kind of psychological shift? Fear of competition. And let's be honest, the streaming space is a bloodbath right now.
It's intensely competitive. You aren't just fighting other media companies anymore. You are fighting Apple, Amazon, and YouTube.
Which is terrifying because those aren't normal competitors. They are tech behemoths with bottomless pockets.
That's the core of the risk. We call it cross-subsidization.
So explain that.
Amazon doesn't actually need Prime Video to be wildly profitable on its own. They use it as a perk to keep you paying for Prime shipping, where they make their real money.
Apple uses Apple TV to keep you locked into buying iPhones and iPads.
Exactly. So if Apple and Amazon decide to start a brutal price war or bundle their services aggressively, Netflix loses its pricing power.
Because Netflix is the only one in that fight who actually needs the streaming revenue to keep the lights on.
Right, and that creates major churn anxiety. If Netflix tries to raise prices to boost margins, but consumers can get Amazon and Apple for cheaper, people might just walk away.
It's a real threat. And once a user cancels, it costs a lot of marketing dollars to win them back.
Then you have to factor in the regulatory scrutiny.
Washington.
Yeah, the environment in the U.S. right now is very skeptical of big tech platforms. There are ongoing antitrust investigations into how these streaming giants operate.
But there's a bit of nuance here for Netflix specifically, right? Because they didn't buy Warner Bros.
Yes, ironically, staying out of the mega merger game makes them look much cleaner to the regulators.
They don't own the internet service providers. They don't own the legacy cable infrastructure.
They just stream.
Yeah.
So while the regulatory risk is absolutely there, mostly around algorithms and data, it's arguably much lower for them than it is for their competitors.
Okay, so we've mapped the terrain. We have a very compelling bull case and some very real bear case risks.
So what happens next?
Exactly. If you're listening to this, you want to know what the immediate triggers are. What should we be watching over the next 30 days?
The biggest catalyst on the horizon is the Q1 2026 earnings report.
That's expected in late April, so we have a few weeks. What is the one specific number you are circling in red ink?
The magic number is the ad revenue growth rate.
Not the overall subscriber count.
No, the overall subscriber count is the old narrative. The ad revenue proves the new thesis.
Got it.
If that ad revenue growth comes in over 100% year over year, it confirms that the dual engine strategy is working perfectly.
So if they announce, say, 115% ad growth, that could be the catalyst that triggers a massive rally.
Absolutely. It proves they have a highly scalable secondary revenue stream. But conversely, if that number comes in weak, say, 60%, the market is going to panic, thinking advertisers are pulling back.
We also need to keep a close eye on their forward guidance.
Yes. They've targeted $12.2 billion in revenue for Q1. In this fragile market, any miss on that top-line number will be punished severely.
And what about that full-year margin guidance, the 31.5%?
That's the ultimate proxy for their efficiency. If they reiterate that number or raise it, it's a huge bullish signal. It means they're controlling costs despite the competition.
But if they lower it, if they say, hey, we have to spend more on content to fight off Apple.
That's a massive red flag. It proves the bears right about the competitive pressure hurting profitability.
And finally, we can't ignore the macro environment. We have to talk about interest rates.
The Fed is always the elephant in the room. High-growth companies, especially ones trading at 24 times earnings, are incredibly sensitive to interest rates.
Just briefly, why does a potential rate cut help a growth stock like Netflix more than a traditional value stock?
It comes down to the time value of money. Growth stocks are valued on the cash they promise to generate in the future.
Okay.
When interest rates are high, that future money is worth less today because you could just take your cash and get a guaranteed 5% in a bond.
Right.
But if rates fall, that future cash flow suddenly becomes much more valuable. So if the Fed signals rate cuts, you typically see investors rotate heavily back into growth names.
And Netflix would catch a massive tailwind from that macro shift.
They would be a primary beneficiary.
So let's synthesize all of this. We've thrown a lot of data out there.
Let's bring it together.
What we're looking at is a classic market dislocation. You have a highly profitable, accelerating business trading at a steep discount, purely driven by fear.
Fear of competition, fear of macro headwinds, fear of multiple compression.
But the fundamentals are telling a completely different story. The value of the business is rising while the stock price is falling.
And if you take the long view here, if they hit their margin targets, and if that ad business really does double.
Where does the math take us?
Some models have a 2028 price target of $120.
Wow. So from 77 today to 120. That is roughly a 55% upside.
Which is an incredible potential return for a dominant, mature tech platform.
I want to leave you, the listener, with a final, slightly provocative thought to mull over.
Let's hear it.
We've talked endlessly about how Wall Street is punishing traditional media stocks because the linear TV model is dying.
The great cord-cutting apocalypse.
Exactly. Investors are terrified of the media sector right now. Is it possible that the market is blindly punishing Netflix for the sins of the legacy media industry?
That is a really interesting angle. Guilt by association.
Right. The trading algorithms and ETFs just see the media tag and automatically sell.
Even though Netflix isn't a legacy media company, they're the meteor that wiped out the dinosaurs.
Exactly. So if the algorithms are just lumping them in with the dying cable networks, we might be looking at a generational entry point for the patient investor.
The investor who can actually distinguish between the disruptor and the disrupted is the one who stands to win here.
Definitely something to think about. Well, that is the lowdown on the Netflix situation. Whether you lean bull or bear, you now know exactly what metrics to watch when those Q1 earnings drop in late April.
Keep your eyes glued to that ad revenue growth. That is the whole ballgame.
Absolutely. Thanks for tuning in to the Easy Money Show. If this breakdown helped you make sense of the noise, do us a huge favor, subscribe, hit the like button, and share it with a friend who might be stressing over their portfolio. We'll catch you on the next one.
See you next time.